We're talking about the 12 largest share buyback programs in the world right now. We'll start things off here with Apple, the very largest current share buyback program, $90 billion. It's a multi year program. It's actually the second largest share buyback program ever announced, just behind Apple's previous share repurchase program of 95 billion, I believe it was. So $90 billion that Apple has committed over the next few years to buying back existing shares. If you're unfamiliar with how that works, essentially, the company, just like your typical investor, is purchasing their shares and then retiring those shares, reducing the overall amount of outstanding shares. And then, inherently, that's going to increase the value of the shares that are left. It's a very common practice, especially for companies where their employees are compensated and a significant portion of that compensation may be shares in the company that they work for. So taking a look at Apple here, over the past year, 4.5% up. Over the past 5 years, a pretty fantastic 146%. All-time highs here. What do we have? 260, currently at 195. Pretty elevated, 27 price to earnings ratio, especially when you take a look at what revenue expectations are. You see revenue's been extremely flat. In 2021, it was 366 billion. Pretty incredible number to see. In 2024, it was 391 billion. For 2025, though, we're only expecting 407, followed by 431. So revenue growth is only expected in the mid-single digits, 4, 6, and 6%. EPS a little bit better than that, 6.5, 9.5, 10.5%. And you can attribute that better performance for earnings per share to things like a share repurchase program. You're reducing the amount of shares, so the shares that are left, the earnings are higher for those shares. So, you add in a couple percent from the share repurchase, add in that dividend yield, currently only 0.5%. Apple actually, interestingly, has always been more committed to their share repurchase program than their dividend, right? Not that their dividend isn't significant, but they haven't raised it as much, certainly, as they could. The 5-year CAGR on that dividend, just over 5%, but you look at that payout ratio of just 14%. Obviously, a company like Apple could be a dividend growth monster with their amount of cash flow, their balance sheet. I mean, you're talking about a nearly $3 trillion company. Certainly, they've traded above $3 trillion. But debt is only $98 billion, cash almost $50 billion. They make enough cash flow almost on a quarterly basis to wipe out their debt if they wanted to. So, consumers, investors who have invested in Apple for a long time have often criticized the company for not raising the dividend more. Apple simply prefers to execute their share repurchase programs, probably because the executives making those decisions are heavily compensated in stock, so it benefits them more. Definitely from a tax perspective, with when you're talking about the volume that they have for share repurchases as opposed to dividend increases. The second highest share repurchase program currently operating is Meta, the artist formerly known as Facebook, with an $80 billion plan, including their recent $50 billion expansion. So you had $30 billion on the previous plan, recently increased an additional $50 billion, bringing the total to an $80 billion plan. See, over the past year, shares of Meta up 35%. Over the past 5 years, 170. And over the past decade, a cool 700% return in Meta. Back in 2025, up here at 725, spiked down to, what is that, the high 400s. So Meta currently trading in the upper half of the 52-week range, 442 on the low end, 740 on the high end. Price to earnings of 24.5. I think the S&P 500 right now is at a 21 or a 22, so slightly higher valuation on Meta than the overall S&P 500, which, we'll take a look at the metrics here, but certainly you could argue that it should be more richly valued. Looking at the revenue expectation up and to the right, we're expecting revenue growth of 14, 13.5, and 12% growth. So that certainly is higher than your average S&P 500 company. EPS slightly lower than that. Previous growth has been great. I mean, look at these margins, right? Gross profit margin, 82%. Net income margin, 39%. Unbelievable. I mean, balance sheet on a $1.5 trillion company, they've got more cash than debt. It's pretty amazing, actually. So $49.5 billion in debt, over $70 billion in cash. They did recently start paying a dividend, so that was exciting for investors who are focused on that aspect of your returns. Annual payout will be $2.10, just an 8% payout ratio. So, yeah, I think they have room to grow that. Dividend yield of just 0.33%. So, look out for future dividend growth there, in addition to this outstanding $80 billion share repurchase program. Number three, highest share repurchase plan is Alphabet, Google, two share classes, GOOG and GOOGL, $70 billion plan, just just recently announced in 2024, April of 2024. It was an additional authorization. Shares have really been beaten up in Google. It has recovered, right? Shares traded down to 144, now back up to 168, but well off the recent highs, or I should say all-time highs of 207. Year to date, shares are down 11%, so you're still in correction territory, even after the recent somewhat recovery here in Google. But over the past 5 years, you've still made 137%, and over the past decade, 518%. But look here, price to earnings ratio 17.5, so significantly less richly valued than the S&P 500. And you can certainly have an argument around either you think that Google's primary income revenue or income stream is their search, right? The advertising that they can sell to companies that want to appear in search results. Well, you either think that AI and the several competitors in that space are going to completely disrupt that model. I mean, just recently, Google announced their AI mode, and they're going to have to figure out how to build search results or advertising into that new approach. So you either think that their primary income stream is going to be completely disrupted and revenues are going to fall off, or you think that Google Alphabet is going to figure it out and arguably the best business model of all time is going to be okay. So that's the reason, that's the justification for the sell-off in shares. You do get 84 cents annual in the dividend, another recent dividend payer, as we've seen several of these mega cap tech stocks very recently authorize a dividend. And that represents a 0.5% yield on this $2 trillion advertising behemoth. Revenue, we are expecting revenue to continue to trend upwards, up and to the right. We'll see how AI and the potential disruption there impacts things. We're expecting revenue growth of over 10% for the next 3 years. Sales expected in 25 of 387 billion. 2 years later in 2027, we're expecting 473 billion. So kind of hard to fathom those numbers. EPS growth expected for the next 3 years over 19%, 6%, and 13.5%. And I mean, here you go. Just like we saw with Meta with the incredible margins, here you go with Alphabet, 31% net income margin, almost 60% gross profit margin. Speaking of a healthy balance sheet, it really doesn't get any better from a balance sheet perspective than some of these mega cap tech names. $2 trillion market cap, almost $100 billion in cash just sitting on the balance sheet, 28.5 billion in total debt. Obviously, they could wipe that out with the stroke of a pen if they wanted to. And as we mentioned, 0.5% dividend yield, 84 cents annual payout, and just a 11% payout ratio. They will go ex-dividend. God, it's funny to think about Alphabet, Google going ex-dividend, but on June 9th with a payout date of June 16th. The fourth largest share repurchase program in existence today. Another mega cap tech name, surprise, surprise, Microsoft. 60 billion, up to 60 billion has been authorized by the management team there. Shares have just ripped lately. I mean, we dipped down, during the tariff panic, down to 354, 350, 344, it says on the low end. And here we are at 450 just a couple weeks later. So pretty wide dispersion on that 52-week range. We are certainly near the top of it. But the upper bound of that range would be 468 with 344 on the low end. Looking at the 5-year performance, almost 150%. You see it's kind of approaching resistance here up around 460. Hit that back in July of 2024. So we'll see if it can break through. But over the past decade, I mean, look at that, 860%. So you've got the $60 billion share repurchase program, and Microsoft, more than the others we've discussed so far, has been committed to the dividend for a longer period of time. Currently yields 0.74%. You're getting $3.32 annually, but very richly valued. Forward price to earnings ratio of nearly 34. Revenue chart looks great. Revenue is expected to grow 14, 13.5, and 14.5% for the next 3 years. EPS 13.5, 13, 17% for the next 3 years. It's actually astounding that the largest companies in the world are still growing revenue and EPS double digits. And you know what? When people argue that the concentration of the S&P 500 is dangerous, and it may be, but there is a reason why these companies continue to grow, or excuse me, continue to be valuated, continue to carry the valuation that they do. It's one thing if you're the largest companies in the world and your revenue is stagnant and you're being disrupted, but these companies, at least up until now, they simply aren't, right? Yes, they're the biggest companies in the world, and you would think that growth would slow down, and maybe to a certain extent it has, but they're still growing double digits. They still haven't been disrupted. The net income margin is 36% here on Microsoft, with a nearly 70% gross profit margin. The balance sheets are the best in the world. Microsoft here, yeah, they've got 105 billion in debt, which is a larger debt load than most market caps of any company in the world, but they've got 80 billion in cash. Looking at the dividend, they've only got a payout ratio of 25%, and that's after they've been growing it at a 5-year CAGR over 10%. They've been growing it for 20 years. Look at this dividend growth chart. Back in 2014, they were paying $1.15. In 2024, almost tripled it to $3.08. It's unbelievable. So, but yes, this was the fourth largest share repurchase plan. Number 5, a little bit of a surprise. Wells Fargo authorized up to 30 billion, which is, let's just say, significant. Certainly on a percentage basis, more significant than any of the names that we've talked about so far, because the market cap is only 237 billion. Yes, that's still massive, but 30 billion of 237 billion makes up a pretty significant percentage, right? If they were to execute on the entire 30 billion that they've authorized, that'd be over 10% return just from the share repurchase. So over the past year, 22% returns in Wells Fargo. Over the past 5 years, actually pretty surprising, up 177. And that's because, you saw back here during the pandemic, shares kind of bottomed out just around 20, now up to 72. When you talk about valuation with banks, I don't really get into it because it's all based off price to book. But here you're seeing price to earnings. Not that that's really relevant for your typical financial companies, so I'm not even going to get into it. But you're getting $1.60 in dividend per year, 2.2% yield. Revenue is expected to be pretty flat, low single-digit growth, 1, 5, 4%. EPS painting a rosier picture there with 1% in 2025, but then you look at 26 and 27, a 15.5 and 13%. Profit net income margin, 26%. Balance sheet, about as much debt as cash, actually more cash than debt. But again, balance sheets with banks is a different story. So really a massive share repurchase program that can be executed on for Wells Fargo here. Next, we're looking at Goldman Sachs, an investment bank, I think biggest in the world. Over the past year, up 31%. Let's not jump ahead. The share repurchase plan that is authorized is up to 30 billion, just as we looked at with Wells Fargo. And again, market cap on Goldman Sachs, only 175 billion. I say only, massive company, but a 30 billion share repurchase program into 175 billion. Let's do the math on that real quick. We'll go ahead and divide 30 by 175. Yeah, that's 17% of the market cap that they could potentially be buying back. If management thinks that shares are undervalued, then there you go, pull the trigger on that. Dividend yield, 2%. So you're getting $12 annually from Goldman Sachs. Shares are $600. And looking at the dividend, it's been an unbelievable dividend growth company. Payout ratio is only 27%, but you look at that 5-year CAGR. I don't know if I've seen that on this large of a company. 21% nearly. 5-year CAGR on that dividend, been growing it for 13 years. And they'll be going ex-dividend here in 4 days with a payout date of June 27th. I mean, look at this dividend growth history. 2014, $2.25. 10 years later, $11.50. Just, I mean, yeah, honestly, I haven't looked at Goldman Sachs too much, but that's about as good as it gets. Had you invested 5 years ago in Goldman Sachs, they're yielding 2% today. But had you yielded 5 years ago, your yield on cost would be 6.5%. So that's what dividend growth can do for you. Next up, what is this? Seven, I think. Let's see. One, two, three, four, five, six. Yeah, seventh largest share repurchase program that's in place today is Visa, ticker symbol V, 25 billion, so 5 billion less. It is a multi-year program. With Visa, it's a tale as old as time. Between the dividend growth and the share repurchase, we'll take a look at their margins and balance sheet. It's just an unbelievable company to own, which is why they trade for a 31 forward price to earnings ratio. Over the past year, up nearly 30%. Over the past 5 years, 83%. And over the past decade, up 400 and nearly 15%. 661 billion on the market cap. So certainly one of the largest companies in the world. Revenue chart, beautiful. I mean, 2024, they brought in 36 billion. We're expecting 39.5 for 2025, followed by 43.5. So revenue growth, I mean, set your watch to it. 10% revenue growth year over year, EPS growth 13% year over year. God, look at these margins. Gross profit margin 98%. No, it doesn't even seem real. Net income margin 53% net income margin. I mean, I don't even know what to say about that. Market cap, we already talked about 660 billion, just 21 billion in debt, 14 billion in cash. Pretty irrelevant when you're talking about the cash flows in this business. Dividend yield, just almost 0.7% because the share price has done so well. Payout ratio 21.5%. They're going to continue to grow this thing like crazy. 5-year CAGR 15%. I mean, it's unbelievable. 15 years of dividend growth. I wouldn't expect that to slow down anytime soon. Back in 2014, they were paying 42 cents. And then 5x to that 10 years later of $2.15. I mean, this is just one of those companies like Costco where you wish you could just go wind the clock back 10 years and just put everything you have into them. I mean, it's unbelievable, the execution over there. Next up, we have, NVIDIA here at $131 per share. They've got a $25 billion plan that was announced in August of 2023. Trading in the upper half of the 52-week range. Man, oh man, has NVIDIA been volatile this year, all over the place with the tariff concerns. And actually, I believe I did miss one. So we're going to go ahead and pull up the company that's right there with NVIDIA, and that is Adobe. So Adobe, shares have been all over share price has been all over the place over the past year, down 15.5%. Adobe, just like in NVIDIA, we'll come back to it, but $25 billion share repurchase plan announced in March of 2024. Market cap here is still 174 billion over the past 5 years. Pretty flat, only up 8%, as there are a lot of concerns around AI disrupting their business, which I think is fair. Over the past 10 years, up 415%, but you see a lot of that was made up before 2020. So $25 billion share repurchase has been authorized for Adobe. Revenue growth is still expected to be 9 to 10% for the foreseeable future. EPS 10 to 12%. Profit margins, you're noticing a trend here, are fantastic. 31% net income margin, 89% gross profit margin, more cash than debt on the balance sheet, and no dividend with Adobe. But certainly a very, very healthy share repurchase program. Coming back to NVIDIA, also that $25 billion share repurchase was authorized. I believe the second largest market cap company in the world behind Microsoft, but NVIDIA here at $3.2 trillion. No short interest. They do pay a dividend, a 0.03% yield. You're getting 4 cents, yeah, so you can enjoy that 4 cents per share owned every year on NVIDIA. Up 27% over the past 1 year. Up 1,400% over the past 5 years, and just 23,630% over the past decade. Certainly, any employee who is an early employee and managed to hold on to their equity, but really any employee over the last decade is a very, very wealthy person. Look at this revenue chart. January 2021, they reported almost 17 billion in revenue. It jumped up to 130 billion in 2025. They report earnings in January, but you're expecting almost 200 billion for 26 and 250 billion for 27. I mean, look at this revenue expectations: 53%, 24%, and 16.5% for the next 3 years. EPS growth expected of 38.5, 36, and 14% into 2028. Looking at profit margins, net income margin of 56%, gross profit margin of 75%, over four times as much cash as debt on the balance sheet, and 20% CAGR on that dividend. They haven't been paying it long. We'll see if they ever decide to take their dividend seriously. A 1% payout ratio for NVIDIA here. I don't know if I've ever actually seen a 1% payout ratio. But that being said, there's not a whole lot of companies like NVIDIA. Moving along, we've got Booking Holdings. They have authorized a 20 billion share repurchase program very recently, just January of this year in 2025. Shares have been great over the past year, up 42%, 205% over the past 5 years, and 355% over the past decade, trading at the very top of the 52-week range. So this one's been breaking out lately. Price to earnings ratio, surprisingly, with the performance, is at 24.5. So I was actually expecting a little bit more richly valued. This one is really all about vacation and travel bookings, hence the name. So we'll see if that falls off as more and more consumers get strained. Maybe certain consumers from the US or Europe or Asia are upset over the political climate and don't want to travel to other countries. We'll see how all that plays out. Kind of funny to see shares, though, at $5,000 on this $173 billion market cap. You see revenue really, really did jump over the past 5 years. We'll see how that trends out. They're expecting 8 to 9% revenue growth, which is great. EPS growth in the mid to high teens. Margins are great, 87% gross profit margin, 22.5% net income margin, as much cash as debt on the balance sheet. And you also get a little dividend here. So they did just recently announce a dividend. You're getting $9.60 per quarter. Keep in mind the share price we're talking about here, well over 3,000. So you're getting $38.40 annual dividend, kind of crazy. But a 0.7% dividend yield. We'll see how they grow that over time. You are going ex-dividend here in Booking Holdings this month, let's say 2 weeks from now, June 6th, with a payout date at the end of June, June 30th. 2 more companies to go for our top 12 share repurchase plans in the world. Number 11, we've got PayPal. Kind of surprising to see PayPal in here. Up to $20 billion have been authorized. They did just announce a recent $15 billion plan, so add that on to the existing $5 billion. From a percentage perspective, this is by far the most significant of any company on this list, which is actually kind of shocking to me. But you're only talking about a $68 billion market cap here with PayPal. And they're down 18% year to date over the past year. Yes, they're still up 13.5%, but well off the recent highs of nearly $94. You look back during the pandemic time when people thought that PayPal and Square were going to take over the finance industry with crypto. And obviously that hasn't come true. We'll see if it ever does. Kind of painful for long-term shareholders, but shares were well above $300. And now you see them here at 70. All that being said, a $20 billion share repurchase plan, obviously management thinks they're undervalued, and maybe they are, but that's nearly a third of the market cap. So shares here should be supported very well by the share repurchase plan. You see, from a valuation perspective, pretty cheaply valued. Price to earnings is under 14, so well below the S&P 500. And why is that happening? Well, simply put, revenue's not growing that fast. You're expecting almost 3%, 6%, and 6.5% for the next 3 years. But, that being said, given the valuation, given the EPS growth of 9, 10.5, and 14%, maybe it is an attractive value play. Margins are great: 41% gross profit margin, 14.25% net income margin, and a healthy balance sheet: 13.5 billion in debt, 11 billion in cash. So I don't know. I think it's probably a popular retail stock, but maybe it is a solid investment. Certainly, management is committed to supporting shares at this price, or they think it's a wise use of their capital anyway, buying back a third of the company's float. Last but not least, I guess it is least in this case, we've got Salesforce, ticker symbol CRM, $20 billion repurchase program. So a little less than 10% of the market cap. Market cap's 262. Shares are trading for a forward price to earnings just under 25. So, healthy valuation here. But over the past 5 years, shares are up 54%. Over the past year, shares are flat. So we'll see how things shake out here. They're really committed to these AI agents. We'll see how that does in comparison to their legacy business model, which is just SaaS, right? I mean, this is sort of considered the SaaS king of San Francisco. Revenue is expected to grow 8, 9, 10.5% for the next 3 years. EPS 9.5, 12, and 16%. Very, very profitable, right? 16.5% net income margin, 77% gross profit margin. As with all these mega cap tech names, I guess this one's not really a mega cap, but it's certainly a beast. More cash than debt: 14 billion in cash, 12 billion in debt. Again, noticing a trend here. It's like they all piggyback off each other. They did just recently start paying a dividend. You're getting a 0.6% yield for an annual payout of $1.66, which represents a 15.7% payout ratio. So hopefully be a future dividend aristocrat and grow this thing for decades to come. Those are the 12 largest share repurchase programs in the world. Hope you enjoyed it. Hope you got something from it. If you did, like, subscribe. Thank you very much for watching. Take care. Have a great week. Bye-bye.